Hello, and welcome to another NABBW Financial Podcast. Tonight, I'm with regular guest Pam Sams to discuss why life insurance is still important for us boomers, our September topic. Pam, back in the 80s when I worked in life insurance, my district manager assigned me to prospect young adults, people who were
Mhm.
just getting married and potentially starting families. And I suspect that is still the age when most people first buy life insurance unless their grandparents or something
Mhm.
buy them life insurance when they're children. Um, but perhaps most of us think that it's less important for us baby boomers since our children are grown and we ourselves are thinking that the next stage in our lives is probably retirement. But
Mhm.
as I looked at the topics that we're going to be discussing, I see that you're talking about the fact that life insurance still has a purpose for us, even can even play a role in our retirement plans, and that while age and health could potentially pose a challenge for those of us looking to buy a new policy, it still is possible for baby boomers to benefit from the coverage life insurance provides. But I'm getting a little bit ahead of myself here. Audience, before Pam and I dive into our life insurance discussion, let me tell you a little bit about us. I'm Ann Holmes, your moderator and the boomer in chief of the National Association of Baby Boomer Women, an organization dedicated to educating and empowering women at midlife and beyond. And with me is Pamela J. Sams, BFA, CRPC, MBA, and trusted advisor to professional women. Pam is a chartered retirement planning counselor and NABBW's retirement planning associate. An expert in personal finance, Pam is president of Jackson Sams Wealth Strategies in Herndon, Virginia, and together we bring you a monthly discussion of important information related to money and financial planning. Welcome, everyone. We're glad you joined us. Now, there's just one more thing I need to do before we can launch into tonight's discussion. I need to play a quick audio clip just to keep us legal. So here we go.
Securities offered through Securities America Incorporated, a registered broker-dealer, member FINRA SIPC. Advisory services offered through Securities America Advisors Incorporated, a SEC-registered investment advisory firm. Pamela Sams, investment advisor representative. Jackson Sams Wealth Strategies, Securities America Incorporated, and all other entities named are separate entities.
All right, we're official now. Thanks, everyone, for joining us, and especially thanks, Pam, for making time for
Yes,
this important topic.
exactly. As I was sharing with you before the call, September is Life Insurance Awareness Month. So every September, I'm out and about in the community and on webinars like this and flooding my social media and everybody else's social media about the importance and benefits of life insurance because I don't think, it's one of those flippant terms. Like, yeah, we need it, we don't need it. And so I think if we could share some of the things that I think people should consider, especially during the month of September, to really evaluate the importance of life insurance and how it fits in your overall financial plan.
All right. Well, thank you for that. Let's start by assuring our listeners that if they haven't yet given serious thought to life insurance lately, you, Pam, are here to help them. You have
Mhm.
10 points that we'll be covering tonight. But I noticed that the first half of the points are focused on situations where we may be encountering in
Mhm.
our lives in which owning a life insurance policy can be beneficial. Things
Exactly.
like you're still working or you have a high net worth or others depend on you. And
Mhm.
after that, we'll talk about some nuts and bolts, types of policies, costs, and insurability. Plus, if I know you, Pam, you'll probably have some checklists or websites or tools that you can recommend to people so they can help themselves figure out the best decision for their own personal situation. So I'm
Mhm.
excited to get going. And Pam, your first point about life insurance is that we can use it to financially protect our family.
Yeah, no, I mean that's kind of the basics of what life insurance is. It's really meant to help protect your family's financial future. Even if you have savings, it is unlikely that you would have enough to cover any family expenses for several years or even decades if something happens to you unexpectedly. So typically there are, a few different types, and we'll get into those a little bit later. But the main, I guess, the pure form of life insurance is really there to protect your family, their financial future, Without it, you probably see online a lot of GoFundMe's. You see, unfortunately, things happen tragically to people, and they're on websites and they're setting up GoFundMe sites because maybe there was not enough life insurance to protect the family's financial future. And without that, the family can run into, I wouldn't say ruin, but it could put a little bit of a strain on a budget if you're not prepared for any unfortunate event that could happen. So the first rule is really to help financially protect your family and the financial future of your family.
And that's so important. My first husband was kind of agnostic about insurance of any type. He had auto insurance because you have to.
Yes, exactly.
But I remember him telling me, well, we should just set aside a certain amount per month that, we're going to save, and then we don't need life insurance. But the point about that is, if you meet an untimely death, if you should die in your 20s or something like that, you haven't saved that much. Whereas if you had set up a policy that's got a set amount that it's going to cover you for, your family is going to get that amount, whether that is amount that you already saved or not.
Exactly. And I know, I get a lot of that that rhetoric as well, as people are like, yeah, if I could just set aside enough, why give an insurance company my money? What if something happened? All of this different things is going to cost too much, which is a misnomer, and we'll get into some of that a little bit later on in the call. But there are definitely people who are anti-insurance. All insurance, like you said, at least with your husband, he had to have, or your ex-husband, he had to have the auto insurance because that's required by the state. So any program that's not, then it's optional. And sometimes people will have just the kind of the either the basics or none at all because they're anti-insurance or they feel they can save enough on the side by themselves. It's always best to really transfer that risk onto a third party, which would be a life insurance company. There's no way you would be able to set aside, $1 million worth of assets if you were not able to have that insured or provided through a life insurance company, where in the event that something do happen to you, your family's financial future is protected with, a life insurance policy.
Now, point number 2 is equally as important, replace lost income, which we've talked about a little bit, the potential future lost income, but I'm sure there's more that you can tell us about that.
Exactly. So, whether you have a 9 to 5, you're self-employed, you own your own business, your income may cover a portion or even all of the basic needs of your family. So housing, food, utilities, clothing, or car maintenance, healthcare, all of those particular things, the premiums are likely to be part of course, your monthly budget. And even without that income, what happens is that families may still need to cover these expenses. So those are expenses or fixed expenses aren't going to go away just because there has been a death in the family. So the death benefit from a life insurance policy can help provide the funds that a family does need in order to help cover the expenses, just as I mentioned before, so protecting the financial future of the family. What most people look at is kind of that replacement of lost income is that, for example, there's a couple of different ways to evaluate life insurance need. And that's what I get all the time is that, how much do I think I really need? So in terms of a replacement of lost income, for example, if you met an untimely death, let's say if you're in your 40s or before retirement, let's just use 40. Let's say you would retire at 65, that's basically 25 years of lost income or replacement of income. So when you're looking at a life insurance need, basically if that person was either the breadwinner or brought in a substantial amount of income into the home, 25 years of lost income times basically the income that person is bringing in is how much you would need to replace, and that's how much life insurance someone would need. That's basically a simple human life value calculation to replace lost income. Now, I know what a lot of times I get is that, that's a huge number. Sometimes it's $3, $4 million. And, I think we get this idea sometimes is that if you have too much life insurance, people get a little scared. They're like something may happen to me or somebody may try to do something to me.
Hmm.
So sometimes people don't like to carry large policies on themselves for that fact. But that is once you plug in the numbers for a replacement of lost income, the number could be rather high, especially like I said in that example, if you're 40 and you had 25 years left of income to make before you retired at 65, then that 25 times whatever income that you're making would be a human life need for life insurance.
All right. Very, very good to remember that and to look at it from that point of view.
Mhm.
Point number 3 on your list, pay off debts of loved ones.
Yeah, so that's just like any other expense, but certain types of debts do not go away when you die. Because sometimes people are like, oh, that person's passed away, debt goes with them. Unfortunately, there's some debts that don't, student loans, things like that. Hopefully,
Hmm.
some of that will be addressed with the student loan forgiveness program, but I digress. I won't get into that. But that means that the loved ones are basically would have to use the money from the estate or either sell off particular assets to cover the debts that was left from the loved one who passed away. And that could lead to less money that you need to pay for the expenses that I just talked about. So if you need to incorporate your debt as one of those expenses, it could eat into what you actually need to cover the day-to-day expenses. So with life insurance, that can really help loved ones pay any debts that you've left behind, including credit card debt, any business debt, any personal and or educational loans, like I mentioned before, mortgage debt. So what do you want to pay off the mortgage in the event of a death, or are you going to sell the property? Some of these things, if you want to keep the property, then you would have to, either pay it or continue the mortgage, which would be another expense that you would have to incorporate. So at the time when the loved one is already dealing with the loss, life insurance can really help ease some of those financial burdens that can experience after passing. You don't want to be dealing with grief and dealing with how to pay off certain expenses at the same time. It's not a really good idea to do so. So having enough life insurance to provide some of that things are going to be taken care of on your behalf, paying off the debt, making sure you're paying the daily expenses will just alleviate a little bit more while you're going through the grieving process.
Excellent. And a good thing to remind people of that, because that one's not one that we hear all the time, paying off loved ones' debts.
Mhm.
When you get the things in the mail and they're talking about can you cover your final expenses, a lot of times
Mhm.
they're really only trying to offer you a very small amount of life insurance,
Mhm.
just enough to cover your funeral, like a $10,000 policy
Yeah.
or something like $5,000 policy. But point number 4 on your list still is an important one, which is cover final expenses.
Yeah, funerals can be expensive, and dealing with the financial stress, of course, like I said, could add to the emotional stress that you could already be experiencing due to the death of a loved one that you may be experiencing. So the family could use some, death benefit from the life insurance policy to help pay for some of these costs. To the beneficiaries, of course, the policy would be direct to some of the death benefits to the funeral home. So to get started, casket and all of the things and the decisions you do need to make. They can pay for out-of-pocket expenses. Can be used. The death benefit can be used for out-of-pocket expenses such as reimbursement for certain expenses, the programs, the repast, the food, the caterers, all of these things that you really don't really think about when you're planning
Mm-hmm.
for a funeral could add up over time. So the basic funeral expenses may be paid, but there may be some other expenses, getting the program together, finding renting space, getting food, paying for extra limos or flights or
Mm-hmm.
whatever needs to be done. So you had mentioned having the small policies, what happens is that most of the time they're smaller policies. They're generally guarantee issue because if you get them a little bit later on in life, and we'll talk a little bit about it later about insurability, is that sometimes you may not actually qualify for some of these larger policies, but you do still need to cover the final expenses. So some of the life insurance companies will provide smaller policies, guaranteed issue to to seniors or older people. Um, Usually they tend to be a little bit more expensive. You know, I'm not gonna lie to you. It's for the cost of it and versus the actual death benefit amount, it may be a little bit more. But at least you know, or at least the family will know that there's a policy in place to cover for some of these final expenses, funeral expenses, out-of-pocket costs that is needed in terms of providing for funeral expenses.
And of course, there could be what you could consider final expenses that might be hospital expenses or
It could be,
ambulance
yeah.
expenses or
Hmm.
those sorts of things. And
Hmm.
those things really add up.
Yeah, exactly. And so that's why I was saying, some of those out-of-pocket expenses adds up that people really don't realize. As you mentioned before, if your loved one was in a hospital before passing away, there may be extra hospital bills. It could be transportation costs to get you there. It could be hospice care that still needs to be paid. All of these particular things, and you haven't factored that into your final expenses. So it's good to know that you have something that will be able to pay for those, both, of course, the preparing for funeral expenses, but also some of the out of pocket that you may not have calculated in in that.
Hmm. Okay. Well, now we're talking about point number 5, pay for future education expenses.
Yeah, I mean, this is, one of the things that if you have children and or grandchildren, sometimes, grandparents want to cover education for children as well. So if you do have children, life insurance can help pay for those future childcare and or education expenses, especially for college. So even if you've already started contributing, let's say to a 529 plan or something like that, a death benefit from a life insurance policy could provide that additional money to help cover children's education if in the event that a parent had passed away. You see a lot of stories. I work with an organization called during Life Insurance Awareness Month. It's called Life Happens, and they have these vignettes or these video that we use to really explain to people what happens in the event that somebody passed away. So let's say a young child whose parent passed away due to just death or illness, and they had planned to go to college, and then all of a sudden there wasn't enough life insurance, and this person's trajectory is quite different than if life insurance had been there for them to cover the child's education. So that's what that life insurance can pay for. So back to the replacement of lost income, calculating that also in that human life value calculation is, what do you want to see happen in the event that you do pass away? Do you want to still educate your children? You want them to go to, a university or a 2 year or vocational or whatever the case may be, and maybe give them a little bit extra to kind of give them a leg up after they get out of school. That's the thing, the benefits of having a proper life insurance to pay for some of the things in your absence. So really calculating maybe future education expenses if you have young children or you have children that need to go to school and you didn't plan accordingly and have enough life insurance to cover that expense.
Excellent. Okay, point number 6. Now we're getting into the second half of the discussion. We're
Hmm.
talking about types of life insurance. And in the old days, there was whole life, and then they came up
Hmm.
with term life. And you're going to tell us about there's at least 2 other kinds by now, I think.
Yeah, there's a variety of different ones, and like you said, the industry had started off with whole life, and that was basically, and I'm sure that's when you were selling life insurance as well, back in the day. And is that was what the popular, I guess that was the insurance of choice was. It started off as whole life, and this is basically where the owner pays a fixed premium as and has a guarantee death benefits for as long as the policy is in effect. So as long as you're paying the premium, you become uninsurable at some point. As long as you're paying the premiums, you still have coverage. Now there is guaranteed issue that it does not involve any medical exams or health questions. Applicant can be denied, of course, and I'll talk about insurability in a little bit. But the thing about whole life is that basically you pay premiums your whole life, and then there was an endowment at the end, usually 100, age 100, and then that's when you get the cash value out of it. So kind of the two types of insurance, I probably got a little bit ahead of myself, is term insurance, which is basically temporary insurance. So this is insurance that is purchased in specific amounts of coverage, and the policy stays in effect for a certain period of time, or temporary. So they generally run 10 years, 20 years, 15, I'm sorry, 10, 15, 20, 30 years. I think I may have recently even seen a 40-year policy. There may be some carriers doing that. But it's temporary. So after that
Mhm.
term is done, that's the term, which is temporary. Basically, life insurance goes away. So what happens? You're 10, you're 20, you're 30 years older now, and if you want more insurance, guess what? It's going to cost you more because now you're 10, 20, or 30 years older.
Mhm.
So that's what happens. Sometimes people price themselves out of term insurance. It's good for, let's say, short-term needs. So if you have young children, and then let's say you want to take care of them until age 18, and then or 21, or whatever the age you want to, and then after that you're like, okay, that's fine. They're on their own now. Maybe I don't need as much coverage, or I'll have a certain term for that. For like explaining before with the replacement of lost income. Let's say you have young children and you need to take them up into a certain age, and after that has been done, maybe you don't need as much coverage for life insurance. So temporary is good for that. The permanent insurance, like I said before, with whole life, and then I'll go over a few other types of permanent insurance policies, stay in place for as long as you're staying if you're paying the premium. So with whole life, you generally pay the premiums your whole life. As long as you're paying them, then you have insurance coverage for that. Um, After whole life, the life insurance companies are innovative. So what
Mhm.
happened generally with whole life, sometime in the 80s, just kind of a short history lesson on life insurance, is that in the 80s, well, whole life policies are tied to a cash value. So the premium has a cost of the actual insurance, like you would have in a temporary policy, and then a portion of the premium goes to a little cash account to build up cash value. So with whole life policies, it was generally a fixed amount, usually in the general account, life insurance company, and they would give, maybe 2, 3% as a rate of return. And then that's how you grow your cash value in a whole life policy. What happened in the 80s is that, I'm sure you remember, Anne, is that CD rates are like 12, 13, 15%.
Mhm.
And so people weren't buying like the whole life policies, because why buy a whole life policy with 2 or 3% as a rate of return? I can go buy a CD that's paying me more like 12 or 15. So, like I said, life insurance companies are fairly creative. They came out with universal life. So, with this, some policies will allow you to adjust the death benefit and the premiums within certain limits. So, instead of now the cash value being tied to the general account in a life insurance company, now you had CD type rates inside of a life insurance policy. So, universal life came. So, at some point, you didn't have to pay the premiums your whole life. You could stop at some point, and then the cash value would be build up, and it would pay for the cost of the insurance for you, because it was um, growing more than that 2 to 3% like a whole life policy. So universal life became kind of the life insurance of choice during that time period. And then we went into the 90s, and what happened in the 90s? Basically, the stock market started growing, and
Mhm.
everybody was buying mutual funds, and so they weren't buying CDs or basically universal life with CD type sub accounts in it. CD rates went down tremendously. Everybody was buying more stocks and bonds and mutual funds and things like that. So again, the life insurance company was a little bit more creative and they came out with universal life policy. Instead of now, the policies may be um, tied to mutual fund like sub accounts, where the mutual fund like sub accounts are basically invested in the stock market. And so universal life, you still have universal life and you still have all of them. You still have whole life, universal life. It's just a variety of what do you want your cash value to be tied to. So the 2 to 3% generally in the fixed account for the life insurance company. Universal life now generally still more CD type rates, so it may be a little bit lower. And then universal life, which may been called VUL, was mutual fund like sub accounts. Um, Only if you have a comfortability with a certain amount of risk, because you are involved with mutual fund like sub accounts inside of a VUL. So if you're not careful, or if you're not working with a licensed and life insurance agent or somebody or financial advisor that can monitor the policies, you could end up not feeding it could end up not growing appropriately because you may have taken on too much risk. Now the portfolio or the sub accounts are down and you don't have enough to pay for the cost of insurance. So be careful if you are in some of these policies. They need to have policy um, uh, run policies every year, kind of an update just to kind of see how it's running. So with that, and then the other one was that recently came out not too long ago was Index Universal Life. Similar concept, but now the sub accounts are tied to an index, a stock index, S&P 500, Russell 1000, all of those similar types of risk. What happens is that you don't have full market participation in it. So if the index goes up a certain percentage, that's how your sub accounts are credited with that. So if the stock market goes up a certain percentage, let's say it's 8%, there may be a 2% haircut because of the cost of insurance and the other fees involved. You may only get 6%. So it's not a bad idea. It's just which policies do you want, the whole life, universal, variable, or index. But I guess the main two differences that you do need to could be concerned about is the temporary insurance. Do I need just a short term to plug in for a short period of time to cover um, a lot of a need during a particular period of time, maybe educating kids or raising kids, where you have a more of a life insurance need? Or do you want permanent policy where you want the insurance your whole life in order to tap into some of the cash value? So that's kind of, the differences between the permanent and the term insurance.
Mm-hmm. All right. Now the thing that we've kind of alluded to, but we're going to cover it in more depth with question number 7, is the determination of how much insurance do you need?
Exactly. And I went over that a little bit before, but there's kind of two different ways to kind of look at that. One is the human life value calculation that I mentioned before. And then you have a needs-based calculation. So really looking at how much are you going to need in terms of life insurance. So you would calculate what your monthly expenses may be. Do you still have a mortgage? Do you still want to educate your kids? All of the things that you think you would need in your absence. So it's more of a needs-based calculation. And there's a variety of different life insurance calculators that you can do. I have one that I use with my clients that I could definitely share it as well. I can send you the link and people can kind of plug in their variables and they can find out how much they need. But that's a needs base. And then you have that human life calculation that I had mentioned before. So the amount of years you would have worked given your income. So like I said, for the example I used before, if you're 40 and met an untimely death, unfortunately, and you still have 25 years of work, if you were to retire or a normal retirement age at age 65, you basically have 25 years of lost income times how much you're making. That's your human life calculation. So you put in I know it's kind of hard. You don't want to put a number on your life, but that's how much you would be worth in that particular household if you met an untimely death. So anywhere between a needs based and a human life value calculation, maybe somewhere in between. I always use the kind of the analogy of the goalpost for clients. You have a needs base, you have a human life value, and then somewhere in the uprights, if you get a
Hmm.
nice field goal, you could come up with a decent calculation of how much you would actually need. Because, like I said, sometimes that number on the human life value may be a little bit more than what people want to cover. It also may be a little bit more expensive. If you're getting $5 or $6 million worth of life insurance or something like that, it may not fit in your budget. So, coming up with something that's fairly comfortable with what you would actually need for your family to bring in, but then also is it going to fit in your overall budget for your financial plan as well?
Right. And then, of course, everything in life has a cost to it. So we need to talk about
Hmm.
cost of life insurance, which we've mentioned a little bit about that already, but there's a lot more to
Hmm.
cover with cost.
Exactly. And, it's one of those, this is not going to be one of those, this is how much it's going to cost. I'm just going to give out that disclosure right now. So I'm talking in generalities, but, the cost of the life insurance is actually going to depend on a few different things. Number one, such factors as age. How old are you? Of course, the younger you are, the cheaper the life insurance would be. There are a variety of different opinions on having life insurance on children, but children are, you're as young as you're going to be. So having a policy on your child may be a permanent policy where you build up cash value a lot quicker and then perhaps transfer that policy to the child when they get age of majority, maybe 18, 21, whatever you decide is comfortable for your child,
Hmm.
may be a good starting point for them. So, like I said, that's probably going to be the cheapest that you're going to get it there. I have a couple of policies on my children as well. And when they get to a certain age, I feel comfortable, then we'll transfer those policies over to them for a nice little boost. So, age, of course, gender. Unfortunately, women tend to pay a little bit more in life insurance because we tend to live longer. I'm sorry, other way. Um, yes, the other way. So guys are going to pay more in life insurance because they don't live as long as women. So the life
Hmm.
insurance company feels that, of course, something could happen, and so men tend to pay more in life insurance. Um, for that fact, unfortunately. It's going to depend on your health. If you're healthy, then more than likely the cost would be a little bit less than if you're not healthy. Sometimes, you could be underwritten for a policy if you have certain health issues, but it may be what we call rated. So life insurance company will insure you, but you will have to pay a little bit more because you may be a health risk. So the cost could be affected by being rated on a policy due to health. If you're a smoker, that goes back to your health. They will rate you a little bit higher because of things that can happen, emphysema, lung cancer, all of those things with smokers. So there's a smoker rate and there's a non-smoker rate for life insurance. So if you're a smoker, prepare to spend a little bit more. They do ask the tobacco question. So if you're chewing tobacco, or if you are a smoker, or if you had, other uses, marijuana, things like that, they were going to rate you as a smoker, even if you've had it for a little bit. So be careful the way you answer the questions when you do your life insurance exam, but you could get a smoker rate for that. Also, it will depend on your hobbies. Some of the questions that they go through are: Do you ride a motorcycle? Do you skydive? Are you a pilot or a commercial pilot? Not a commercial pilot, but private pilot that you fly planes. They all of these things. Scuba diving, that's one as
Hmm.
well. And then how far do you go down when you scuba dive? So hobbies could have an effect on the cost of your life insurance as well. So these are some of the things that you have to consider. Temporary versus permanent. Permanent policies, because some of that premium is going to the cash value. So permanent policies tend to be more than temporary. Temporary insurance, like I said, goes away at a certain period of time, 10, 15, 20, 30 years. So if you lock in a rate, if you get it when you're younger, then the premiums may be cheaper and they're going to stay that way until the policy term expires. Permanent insurance tends to be a little bit more. So that's why it's good to, go and check it out on a calculator to see where you fall, do maybe a prelim on some of the health questions. So if you know that you take certain medications, you may be a smoker, and they go into a little bit into family history as well. So if you have parents that died younger, had heart issues, diabetes, things like that, they do evaluate that as well, unfortunately. Um, so those are some of the things that could affect the cost of insurance. I can't tell you exactly how much it's going to cost, but when you do the calculator, put in some of those variables, and it'll kind of spit out to you what the rates would be when you get your quotes based on the age, your gender, your health status, your smoker status, and any hobbies that you may have that tend to be a little bit more risky.
Now, something that I've never had anyone ask me when I was working with insurance, but what if you answer all those questions totally correctly when the policy is issued, but situations change over time? So you take up skydiving 15 years after you told the truth and said, no, I don't skydive. Do you have to call your agent and say, I've taken up skydiving?
No. So as long as when you're underwritten for the policy, and as long as you're paying the premiums, then and you become, that's what I'm saying, at some point you may either develop a health issue, you may take up sort of risky hobbies. As long as you're paying the premiums and you become quote unquote uninsurable in that term, they're not gonna know, and unless you disclose it. But they still, as long as you're paying the premiums, you're fine. So you don't want to raise any red flags. But like I said, as long as you're paying the premiums during that particular term, they're not going to come back and say, okay, no.
Okay. Well, the families that's been expecting that you have a certain amount of policy would certainly be upset if they suddenly said, no, we're not going to cover that because you didn't tell us that you took up skydiving.
Yeah,
so
exactly. Now, the caveat being, if you decide at some point you started kind of with basic life insurance, you're like, hey, I want some more life insurance, and you want to add on, and then you may have to go through underwriting again, and it comes out that you may have taken up some different things since the last time you were underwritten, then it could come out that way. So only if you go back and try to increase your death benefit amount, or if you want to maybe upgrade. So some insurance companies will allow you to take a term policy and convert it into a permanent policy. Sometimes they require an additional underwriting during that. If sometimes they don't, so it depends on the carrier. But that would be the only way they would come back and start asking you questions again regarding your insurability.
Okay. So you've got question number 7. No, we just covered that. How much do you need? I think we just covered that. So we're at question number 8, cost of life insurance.
Yep. We just covered the cost of life insurance. So I think we're at 9.
We're flying through this so fast here.
Yeah, we are.
Is number 9.
Yes. So insurability, just what I mentioned before, that's why the best time to get life insurance is when you're healthy. And sometimes when people decide, hey, I want life insurance after the fact, because now they're starting to think about their mortality if they are unhealthy. But unfortunately, the best time to get life insurance is when you're healthy. So like I said, at some point, unfortunately, we're living in society, things happen, we develop diseases, we end up on medications, something happens, and at some point we may become uninsurable, and then you're not underwritten and for any life insurance company at all. So that's why I said, if you have the opportunity to put something in place, uh, even if you have group insurance, I mean, group insurance, they kind of look at it a little bit differently. They don't do a whole lot of underwriting. Generally, with your employer, they give you 1 times your salary as a life insurance benefit for you. So if you're making $100,000, you'll get 100, times one, basically is 100,000 of life insurance. If you leave that employer, life insurance goes away. So the misnomer is that most people that I speak with, they're like, hey, yeah, I got life insurance. Do you have any life insurance outside of work? They go, no. Okay, so you basically have group insurance, which you don't need to go through underwriting for. But if you leave that employer, basically you have no life insurance after that. So it's also good to evaluate and get some life insurance policies outside of your employer. But nonetheless, back to insurability, is that once you become uninsurable, and you are denied for life insurance, it's just like, I guess being denied for credit cards. You just can't go to another carrier and say, let me try here, let me try here, let me try there. They keep record. So the questions are, have you ever been denied for a life insurance policy? And you do have to answer truthfully. So if that's the case, you may not be insurable through any of the carriers. Now, that being said, if that happens, there are some, and again, go back to the cost of insurance, may underwrite you if some of the other ones, they're usually rare and they will cost you a lot of money to get the life insurance with it. I'm not to say that you can't, but it's very slim chance once you become uninsurable to get life insurance, unless you go with one of these carriers who take on more riskier cases, but then the cost may be more than you want to spend for that. And again, it's back to what we talked about the final expense. They may not give you a whole a bigger policy. They may just say, okay, we'll give you 10 or 15,000, and then they're still charging you a higher premium. If that's all you are able to get, go ahead and get it because you need to provide for the final expenses. But that may be the situation that you're put in if you become uninsurable.
Is it possible to stack up a whole bunch of those little $5,000 and $10,000 policies from different companies to add up to something bigger?
to add up to it. I'm sure you probably, I'm not that little, but they just, again, with the applications, they're going to ask you, do you have any other insurance policies? And they will evaluate, they will kind of see that you may be stacking up based on that. So that's based up to any the particular carrier. I guess you could. What I've seen is some people have maybe a couple of 25,000 policies to make up 50. I haven't seen, really stacking it up where you're getting into the high numbers, but you're able to have maybe a couple. But each life insurance company will evaluate. They will ask the questions: how much additional life insurance do you have outside of the policy that you're actually applying for, and then they will evaluate that accordingly.
All right. So question number 10, where to get life insurance?
Mm-hmm. Exactly. So there's a variety of ways to get it. Of course, a lot of people go online. You just do a Google search. I'm looking for life insurance. There's like eQuotes and there's a bunch of other stuff. Um, and then you can get it that way. You can go to your local life insurance agent company. There's a variety of different companies that are out there that offer life insurance, so you can start there. Financial advisors also, if they are licensed to provide life insurance solutions to you, you can do that as well. So your financial advisor, a life insurance agent, and you can also, of course, Google search and do a search online, and put in your information, and then you'll have, again, a variety of life insurance agents who will call you to sell you a life insurance policy as well. You definitely want to make sure when you are evaluating carriers, how long the strength of the company, how long they've been in business. Um, they have what they call a rating, a Moody's rating, 3-star, 2-star, 5-star. You want to make sure that they're a reputable company, and that the life insurance agent is working in your best interest and not just trying to sell you the biggest policies that are out there. Evaluate your needs base and your human life, and then really working with you to come up with a proper solution as well. And you want to evaluate, when you get quotes, you want to probably look at, you'll probably get about, you depending on the screener, maybe about 5 to 10 different companies. Don't just go on premium, because I know a lot of times people go, well, this is the lowest cost, I'm going to go ahead and grab that. Again, you want to look at the reputability of the company, how long they've been in, what their ratings are, um, what the underwriting may look like. Are they, asking for your firstborn, during the
Mhm.
application process? So just don't go with the cheapest uh, provider out there. Do your due diligence and evaluate a couple of different ones. Now, you don't want to go and start applying for each one during the quote process. You want to talk to the agent. You want to go through, the pros and cons of each particular carrier, what you're getting. For the most part, temporary insurance, you could probably get it at any of the provider. There's some that offer certain benefits. There's certain companies that have what they call living benefits for temporary policies. So if you become chronically ill or disabled, you may be able to tap into the the death benefit amount. So there's carriers who have special types of policies. So you want to know that as well when you go to see where you can get a policy from. But the most part is really going with a life insurance agent or financial advisor, a real person, versus kind of some of these quotes online and applying online. That way, you get a person who, if something, your lifestyle changes and you add children, and or you increase your job, and now your replacement of your lost income is more, you need to evaluate these things as an overall part of your financial plan. You may not just want to go with a life insurance quote that you've typed into the computer and then you bought it online and you don't have anybody to really talk to. So I recommend generally either going with an advisor or a life insurance agent, so you have that human connection that will know what's going on with your overall financial plan and how to make adjustments according to your lifestyle.
And I think you alluded to earlier the concept of fiduciary responsibility.
Mhm.
So that they're not just trying to sell the biggest policy
Exactly.
to make their quota for the month, but they're trying to make the policy that fits your
That fits,
specific
yeah.
needs.
That fits your particular need, because that's the benefit of it. You just don't want to, there's no such thing, I guess, if it overinsured, but you want to make sure it fits a policy that fits and it's designed properly as well.
Okay.
Yeah. Now, I know that was all the questions that we had, but I wanted to kind of go into, because I didn't cover the benefits of cash value life insurance, because I know sometimes people go, you probably heard the age old, why don't I just buy term and invest the difference? I get that a lot. It's like, uh, why build up cash on a life insurance policy when I can go invest it myself? And there's a variety of different things that you can do or think about. Cash value inside of a life insurance policy does have tax advantages. So cash value accumulates on a tax deferred basis, and then withdrawals taken as loans are tax free as the policy is in force, versus if you did uh, term and invested the difference, you may get a 1099 of your investments each year, if depending on how they grow, versus the tax deferred basis if you have it in a life insurance policy. So the tax advantages as well. You can use the cash value as income. So a portion of the cash value can be used for anything that you want, supplemental retirement, um, estate planning, anything that you want to do with the income that's coming from the life insurance policy. You can also use it to help for college costs. I do some programs with young, you do have to have a little bit longer time horizon, but I do programs with younger families with younger kids to perhaps use some of the cash value to pay for college costs a little bit later down the road as well. Now, of course, some of the drawbacks for a cash value policy, I have to give you the pros, but also have to give you the cons. It tends to be more expensive, like I said, than policies that do not have that cash component. So plan to know that you may spend a little bit more if you want a permanent policy versus a temporary policy. It does take some time to build cash value, so you can't just start a policy and then next year you say, "Hey, how much cash I got in there? Can I get at it?" So it does take some time to build a nice cash value. And then cash value is not actually paid to heirs. They will get the death benefit amount, the greater of the two. So if the cash value is more, they do generally just get the death benefit amount and not the cash. So that could be some drawbacks that people should consider with that
Hmm.
for the most part. There are tax advantages of the cash value life insurance, and you can use it as income.
All right. Well, you are correct. I have a question and we have
Hmm.
a listener question that actually
Okay,
came in yesterday, but that's
got
because
it.
we promoted it. So my
Hmm.
question is, what about using life insurance to fund a legacy project or charitable events, charitable gifts? Say if we've always dreamed about being able to fund an organization or church or school that we support, or even support
Hmm.
a pet project, does it make sense to utilize life insurance for this?
Yeah, I mean, yeah, as your part of your overall estate plan, you can use life insurance. You can use it. You can put life insurance as a trust. I'm sorry, the beneficiary as a trust on that, and then the trust will pay out to the charity, build a legacy, and what you need for that. Of course, definitely consult an estate attorney to make sure you are doing it properly and set up the way you would like it to do. But a life insurance could be a means to fund that particularly legacy project.
Okay, excellent. And then the question that came in from our audience says, from Jean, last month when you talked about long-term care, the cost of it really frightened me because
Hmm.
I don't have an LTC policy.
Hmm.
Could you talk about the pros and cons of cashing in my current life insurance policy should I find myself in need of long-term care?
Okay, so we're going back to the long-term care. Yeah, that was a powerful discussion
All right.
to get into. Um, it depends on what you're trying to accomplish. So I think what we talked about last month with the long-term care, and then qualifying for certain benefits, Medicaid, things like that. The cash value will be used first in those policies to either pay the long-term care nursing home, assisted living facility, and then you maybe draw down into a Medicaid qualification. So I guess yes and no. It just kind of depends on where you are in the planning stages of it. But if you think you may eventually have to qualify for Medicaid, then the cash value will definitely be taken first to pay for some of the care, and then the other resources will be drawn down, and then you would be able to qualify for Medicaid.
All right. Excellent. I think a lot of people really had their eyes opened by last month's discussion. Long-term care is a very expensive situation.
It's yeah, it's a very expensive situation. But those are definitely good questions. And back to kind of that along those lines with what she asked is that, sometimes people aren't able to, I know I've mentioned several different times in several calls that standalone long-term care policies tend to be a little bit more expensive these days because there's not a lot of carriers out there that will underwrite it. So there are options. Usually, since we're talking about life insurance, some life insurance policies you can do life insurance with a long-term care rider. So there's a variety of different carriers that have products that are out there that will use. So in the event that a long-term care event happens, you can tap into some of the death benefit to cover for long-term care needs. There's annuities with long-term care riders. So if you're receiving income out of an annuity and a long-term care event happens, they will some carriers may step up the actual income that comes out of the annuity to cover long-term care costs. So there's a variety of ways to do it instead of just using a standalone policy. But again, you always want to consult a licensed life insurance agent and or a financial advisor for your particular needs, so you can get the best solution for you.
Mhm. All right. Well, those are all the questions that have come in that I'm aware of, but there might be other things that you'd like to cover, so I'll
Yeah.
ask you that.
Yeah, I think we cover everything. Like I said, this is my month to really just, hit do kind of a roadshow on the importance of life insurance, especially during September. So like I said, I mentioned Life Happens. That is the organization that really kind of touts the life insurance awareness. It's called Life Happens. You may see the hashtag LIAM22 that makes it Life Insurance Awareness Month. That's what that stands for. Hashtag Get Life Insurance. So you'll probably see that splattered around for at least the next week as we wrap up September. But go to Life Happens and really look at it. They have calculators. Like I said, I mentioned before. I also have life insurance calculators on my website if you want to look
I was
at
going to mention that.
a needs
Have that
based
checked today?
on figuring out what you need for life insurance. But look at some of those vignettes on lifehappens.org. It really gets into I'm not trying to, guilt trip people into getting life insurance, but it goes through real life stories of people who did not plan accordingly and left their families um, a little bit behind the curve with resources because life insurance was not in place. So yeah, I think, and then Life Insurance Awareness Month also has a spokesperson. I can't remember her name, but if you go there, you can see it. She's a famous actress. They usually get some celeb to do the Life Insurance Awareness Month promotions. And then she goes into her family story of not having enough life insurance when she was growing up as well. So, this conversation is real about, why life insurance is important. Sometimes we do take it for granted until you're actually into a situation where you're dealing with the death of a loved one. It becomes real when you're
Mhm.
when you're planning for funerals and when you're looking at the extra out-of-pocket costs, or you're looking at a child that needs to be educated and there may not be enough life insurance there. So that's why I'm really passionate about, of course, life insurance and financial planning overall, but especially during the month of September, really talking to people about the importance of life insurance.
One other thing that just occurred to me is Keyman Insurance, which is a
Hmm.
situation I saw on a company that I worked with
Hmm.
for 30 years was a partnership, and one of the partners died in a motorcycle accident. And
Hmm.
then because they must not have had Keyman Insurance, the
Hmm.
remaining partner had to sell his company because he wasn't able to um, go forward on his own because of the loss of the
Because of the
partner.
loss of, yeah, and that's what, that whole, the second point we talked about was the replacement of lost income or lost resources. So with the
Mm-hmm.
key man that you had mentioned is that really assuring the cost of if a person and our partner, let's say a key person in your organization, a partner or a person who brings in, a certain amount of revenue or whatever the case may be for your business, and that person is not there could be a substantial loss. So really having that key person or key man insurance in place would be able to, do that. Same thing with the buy sell agreement. So if you do, there's a variety of different ways to use cash value life insurance or life insurance in general. In terms of business planning, but that's one of them, key man insurance, and also a buy sell agreement. So in that instance, in the event that somebody had passed away, you basically do have life insurance policies on each other. So if that person passes away, then you're able to buy out either that side of the business to keep the business going, or buy out their spouse. So, your spouse would inherit the partnership. You may not want to be in partnership with the spouse, so
Right.
you would buy that spouse out their interest and then keep the business running without having those resources. Like you said in that example, that person was not able to continue the business because of those lost resources for that key person, and or may not have a buy sell agreement in place for the insurance to kick in to continue the business. So, there's a variety of different ways to really use it. Business owners really need to also take a look at the importance of life insurance as it relates to their business. If you're self-employed, if you have a small business, if you have a corporation, really evaluate the life insurances that you have on yourself, but also the key people in your organization.
Excellent. Well, thank you, Pam. You've really packed a lot of content in here, giving us a lot of food for thought. Maybe a lot of us thought we understood life insurance, and clearly there's a lot more to know about it than we might have just seen on the surface. So I thank you for bringing this to us, and especially in September, since it's the special months to be aware of life insurance. I want to also thank our audience for joining us, and I want to say this, the audience, I want them to know that if they have any questions after the call, they should feel free to email them to you, Pam, at Pamela@jacksonsams.com, or you can go to Pam's website, www.jacksonsams.com. That's JACKSONSAMS.com. And I went and looked today to see what you were saying about life insurance on it, and I did see that you have plenty of information there about the topic of life insurance. So I advise any of our audience to check that out. Also, if our audience would like to know more about the National Association of Baby Boomer Women, check out our website, nabbw.com. We have a forum at Boomer Women Speak, and a Facebook page at facebook.com/nabbw. So I want to thank you, Pam, for your time tonight, and our audience for joining us. And it's been a very informative call.
Yes, thank you very much. And thank you all for tuning in.
All right. Thanks, Pam.
All right. Good night.
Good night.